Welcome, everyone. My name's Alvin Fan. This is Alpha Uncovered. We're back for a very, very special episode with a good friend of ours, Zan Huang, who is soon to be senior portfolio manager and founder of Kaiyuan Macro. And Kaiyuan Macro is his expression into the macro market, a strategy that is quantitatively based. It's a multi-strategy approach in the macro markets, trading primarily FX and rates. Zan, welcome.
Thank you, Alvin.
So Zan, just a bit about your background for those of us who are meeting you for the first time. You started in academia after obtaining your PhD in information systems at the University of Arizona in 2005, but you wanted to do something new and you started actually your work in finance with AllianceBernstein, developing and managing innovative quant models for the firm in 2011. But you didn't come out until 2015 when you started to do some really interesting work in the FX markets, working with one of the largest FX books in the industry, PGIM Fixed Income. You were there for about 7 years, up until about 2022. Fast forward today, you're going to be launching your new fund. As of the time of this recording, it will be about a month's time. So congratulations on the launch of your new fund.
Thank you.
So Zan, we've been talking for a long time. We've been working together on the launch of your fund. I've had the privilege of sitting through some of the seed investor DD sessions with you. And I think your strategy is probably the first of its kind that we've worked with, where it is taking a quantitative approach, information, structure, and science approach to macro. Most of the macro managers that we've been working with have been discretionary, directional, taking a view. And what's interesting is about today, where after the last 5 years, I think it's safe to say most of the fundamental bottom-up discretionary managers have gotten absolutely creamed in the market. It's mostly been a macro story. And so macro has consistently outperformed most strategies over the last 5 years. I think the only one that did better was multi-manager, right?
Yep.
So for those of us who are meeting you for the first time, why don't you tell us your background and why you wanted to become a fund manager and where we're coming from today?
Sure. Thank you for that introduction. Yeah, so this is actually my second career. My previous career in academia was information systems by training. I was a professor at Penn State for 6.5 years doing exactly that. So I was doing machine learning, data mining type of research. So you can see the natural tendency for me to pivot towards a quantitative approach to investing. Being always interested in finance topics. And when I got my tenure, I wanted to do something different, something closer to the real world. I had this opportunity and then just grabbed it and moved to New York City. It was interesting second career so far. And
this is at AllianceBernstein, right?
Yes.
So you're there for roughly about 4 or 5 years or so.
Yeah.
And so were you developing new models for them or were you working with a team to build existing models? Or
I mean, it was a very kind of a new experience for me because I was purely in academia and I was not even in finance. So I was brought into a team and I would spend a lot of time learning the industry practice of how traditional quant investment is supposed to be. AllianceBernstein is a great place to do that because they have equity strategies and fixed income strategies. They have discretionary portfolio management as well as a very decent presence of quantitative team. So I was in the Currencies team. So I was working really to learn the model and to maintain the model, improve the model. And then I was involved in basically the currency portfolio management. Later on, was also got additional exposure to other hedge fund strategies involving equities and commodities as the team expanded. I consider that those years were the time that really built up my quant investment know-how from scratch almost, jumping from academia, now in the real world, seeing how people are doing things, thinking about potential improvements and issues and problems, and then what could be the solutions and make things better. So a lot of learning, benefiting from colleagues there, a lot of thinking, a lot of long hours of work.
Those 5 years you're at AllianceBernstein, I was thinking back, there weren't too many currency crises actually between 2011 to now. I think obviously there was the Russian war a couple of years back, but prior to that was maybe Argentina and a couple of other South American currencies. But did you see anything that really woke you up to or inspired your strategy at Allianz, or was it until PGIM did you start to pull the trigger?
Currency market is always an interesting market in those days. during those years, we had this big Euro Swiss franc blow up, and FXCM basically shut down because of that. Yeah, so always.
And break it down. We'll break it down what happened actually, just for the audience, just so.
So this is kind of related to the Facebook problem we were talking about earlier. In currencies world, a lot of times you see these currency crosses that show a pretty low volatility, like Euro Swiss. This cross is pretty much managed cross. It has been a pretty low volatility, and then if you're talking about relative value bets, when you are seeing those kind of low volatility, then many people might just leverage up the position. We still see a lot of examples like that to different degrees. Singapore currency is somehow managed to a basket. Chinese currency is also having lower than usual volatility compared to the other comparable economies, because there is.
These are managed currencies for one.
Definitely. Right. So,
and the Swiss franc is also managed for the longest time.
Yeah. So you manage the volatility for a long time. It seemingly such a low vol bet. In order to earn enough return, you leverage up the size until one day it suddenly have a very big jump.
Yeah, a big dispersion from the mean.
So it's almost like you have these internal forces accumulating, and then it was suppressed over this long time until suddenly it bursts.
Right.
So I remember seeing all those episodes playing out. You think about the implication for all the FX managers, because that essentially fundamentally changes how the risk management should be conducted across all the FX managers, because you cannot just use a normal distribution or even something close to that to fully capture the potential risk you are facing. So that actually had a lot of implications to some of the improvements I made into the modeling, like from that episode, in terms of how you treat risk, how you build in your kind of conservative way of estimating risk correlation and all that.
So let's talk about your work at PGIM. So PGIM, Fixed Income House. What's interesting about your role there is that it wasn't specific to one particular strategy. It was an overlay across multiple strategies. Is that an accurate way of describing it?
Well, I joined PGIM Fixed Income in 2015. I was brought in to build up the quantitative FX strategy. So my quant FX strategy covers both the G10 FX and EM FX strategy. Later on, I also expanded that to do interest rate strategy. So again, develop market interest rate and emerging market interest rate. So in that regard, I actually have 4 sub-strategies in my quant framework. And this is an asset management context, not like a typical hedge fund context
which is somewhere between almost treasury management, but there is more in capital preservation and hedging. Was there an element of absolute return targets that you had on the book as well?
Well, yeah, because the entire shop, a lot of the products are not like hedge fund type products, but we do have hedge fund products like emerging market hedge funds. But for my strategy, I'm purely managing these strategies as what I call alpha overlay strategies. So my mandate is to generate alpha. So my benchmark is cash. It's called overlay strategy because these strategies employ derivative instruments, FX forwards, interest rate swaps. They don't essentially need to consume the cash capital, right? Yeah. So it is portable. It can be superimposed onto many different products we have in the firm. So these products are like what I mentioned, the emerging market hedge funds. We also have total return bond funds, emerging market bond funds. These are the fixed income investment products. A lot of the like pension funds and sovereign wealth funds, they look to invest. Total risk budget might not be very high, but these kind of products usually have some risk budget in FX risk taking and interest rate risk taking. So for those products that do have these risk budgets for these kind of risk taking, then they could use the quant strategies I have for FX and rates to generate alpha.
So it strikes me that this type of background and your background, working with multiple hedge fund strategies, not just as a hedge, but more importantly as a risk-taking budget, it would lend itself really well to providing a similar type of service to almost as a B2B to other hedge funds. So I guess this comes to the question of, why start a fund? Because you could replicate this entire model and this function and have a great business providing this service to other institutional hedge funds for what you did at PGIM, right?
Yeah, I mean, early on in my career related to FX currency management, that there are a lot of discussions on these so-called FX overlay funds. Exactly as you described, you can provide this as a service to other funds which potentially can take FX risk, but they don't necessarily have in-house capability to do that, or they prefer to have another alpha source from outside. So you can do it in many different contexts. For example, you can have a equity fund, even index fund, right? So you can have an index fund, just follow the replicate S&P 500.
Yeah.
On top of that, you can add FX alpha, which presumably can be very kind of totally uncorrelated with the underlying equity returns. So that's a perfect scenario.
But that's the whole point, actually.
Right? You can have this portable alpha added to those kind of. So underlying can be the equity, underlying can be just exposure to bonds or any other typical products you see. So yeah, so there were a lot of discussion on those. That discussion died down a little bit several years into my exposure to the field. I suppose part of it was FX management has becoming more and more challenging. In early years, there are a lot of successes, but more and more recently, you just observe it's just getting more and more challenging, and you see many funds and just shut down. There are many famous funds, FX standalone funds, that just stopped operation for under several years of underperformance. So it is probably a global trend that alpha is always difficult.
Yeah.
Right.
Well, that brings us to your fund.
Yeah.
And the thesis of your fund, which is not exactly what you were doing back at PGIM, but this is for the audience. When I look at the track record, it's a very stable return, very conservative approach, right? Your fund is taking a slightly more aggressive approach, using the same models that you were doing for a previous shop, but applying it a little bit more aggressively. So why don't you walk through what those differences are for us?
Sure. Yeah, so going from alpha overlay strategies within a asset management context to a standalone hedge fund, it sounds like a big change. In reality, we do have FX and rates are the major asset classes these macro funds, macro hedge funds utilize to make money. So you see many famous macro hedge funds. They make bets in FX markets and interest rate markets. They probably also do that in other asset classes. I consider the most prevalent asset classes in this space are those liquid derivative instrument markets in FX, in rates, in equity, index futures, and in commodities futures. So you see many other famous hedge funds are also operating in that same space. So a hedge fund that use these instruments take on these kind of risk to generate alpha is not new, right? What I did at this asset management firm, when I bring it out to be a standalone hedge fund, it naturally just falls into that category. And because it was already alpha overlay strategy, it was already alpha strategy, naturally it goes into these hedge fund strategies, right?
So let's break it down. So the strategy itself has 4 sub-strategies.
Yep.
It's trading G7 EM across,
G10 naturally.
G10 EM across both rates and currencies.
Yes.
Right. So it's G10 currencies, one strategy, G10 rates, one strategy, EM currency, one strategy, and EM rates, another strategy for all 4.
Yeah.
And the basis of it is RV, relative value.
Yeah. So a key focus of our approach is putting a lot of focus on the country relative value within these 4 universes.